All right, welcome to a new episode of the Opening Bid Unfiltered podcast. I'm Yahoo Finance Executive Editor Brian Sozzi here at the NASDAQ in Times Square. And like I always say, this is the podcast that will make you a smarter investor, period. And that to that end, you're going to get a lot smarter after this episode. Joining me right now is Richard Thaler. He, of course, won the 2017 Nobel Prize in Economic Sciences. He wears a lot of hats, Richard. He's also the Distinguished Service Professor of Economics and Behavioral Science at the University of Chicago's Booth School of Business. And he manages money. Fuller and Thaler, about $30 billion in assets under management in small caps. Richard, I mean, how do you even have time for me here coming on this episode?
You know, Monday, the golf course is closed.
No, fair enough. And I should also mention, he's out with a new book. And that book is called The Winner's Curse, Behavioral Economics Anomalies, Then and Now. Richard, let's start with the book. You've been at behavioral economics for some time, many decades, seen as a pioneer in this field. You know, what made you write this book now?
I will say it's a weird book. There was a version of this book that was published in 1992, and it was based on a series of articles I wrote in an economics journal under the heading Anomalies. And anomalies are obviously things that we don't expect. So if you saw a bear that had stripes like a zebra, that would be an anomaly. And I published these once a quarter in this journal, and they were pokes at the economics establishment, saying, look, see this? You guys say this can't happen. Here it is. And when I had enough, I kind of stapled them together and published them as this book. And the book was about to go out of print, and the publishers said, hey, you want to freshen it up or something? And maybe stupidly, I decided to do something more ambitious. And I recruited a young colleague of mine, Alex Emis. And we took some of those old columns and some others I wrote and started with those, and then add an update to each one and say, well, is this true? Does it replicate? Or were we just making it all up?
Mm-hmm. What, for those not familiar with behavioral economics, how would you define it?
So it can only be defined in comparison to non-behavioral economics, which the fact that we need such a term is weird, right? Because what other economics could there be? Presumably, like, even now, all the trades that are going on in the background there are people, even if maybe people wrote programs, but there are people. So, but starting after World War II, economics became increasingly mathematical and formal, and the easiest models to write down are of people that are really smart and really selfish. And because economists are not geniuses, and are lazy, they write down models that are the easiest ones to write down. And that means the models are wrong, because the people aren't geniuses and they're not selfish jerks, and they have self-control problems. So if we add a little psychology, the math gets more complicated, but the field gets less wrong. And so that's the enterprise that I started 40 years ago. And this book is kind of an update of where we are.
How has the profession changed relative to 40 years ago?
Well, it's a great question. We did not cause a revolution, in the sense that if you open up an economics textbook, it doesn't really look very different. What's the revolution is, there are now behavioral economists in every top economics department and business school around the world. There are behavioral economics papers in every top journal in every issue. So young people, well, and even not so young, but I mean, I always say that I didn't change anybody's mind. So the people my age didn't change their views at all, but I corrupted a lot of young people, like Alex Emis, my co-author. And so that's where the field is now. It's no longer considered to be to be ridiculous to be assuming that agents are less than fully rational and that markets are not completely efficient. But the field hasn't quite figured out what the standard thing is.
You brought up a good little nugget there, Richard, and it's something I actually had down to ask you because I'm fascinated to get your take on this. I think a lot of investors have become trained to think that markets are efficient. What a stock price reflects is the best available information. It's a predictor of the future earnings power of a company 6 months to a year out, or however you want to look at it. But that doesn't sound like how you view things.
Yeah, so, the efficient market hypothesis is a phrase created by my colleague at Chicago Booth, Eugene Fama, and sometimes golf buddy. There are really two components to it that you alluded to. One is that I call it the price is right. So stock prices are a correct assessment of intrinsic value somehow measured. The other is, say, the no free lunch component, that you can't beat the market. And the latter is, I would say, approximately true. I say that even as a principal in an active money management firm. It's possible to beat the market, but it's hard. Most mutual funds fail. Almost all individuals fail. So it's probably a good idea to start with the idea that you're not going to beat the market any more than you're likely to beat Scotty Scheffler in a round of golf. Yeah. You're competing against pros, and the pros aren't beating the average. As to whether prices are correct, I would say there's virtually no evidence to say that that's true, and lots of evidence to say it can be wildly wrong. And we've had bubbles going back to tulips, and in the relatively recent lifetime, we had the tech bubble in the late 90s. We had the financial crisis, and more recently, then we have Bitcoin. I don't know what we want to think of that. Then, post-COVID, we've had meme stocks. It's still the case that some of these stocks, the prices seem incomprehensible to me. But as I often like to say, I can be very confident that a stock price is too high, but that doesn't mean it won't go up.
Well, then how should one go about building an investing plan? A lot of folks, they love to pick stocks. They're all looking for the next NVIDIA that's going to go up over 1,000% over a 5-year time frame. What do you say to those folks that want to buy stocks and they think they could beat everyone?
I would say that if you want to buy stocks as a hobby, go for it. But do it with a sensible amount of your portfolio, and do something sensible with the rest.
So is it a better bet to go with ETFs that just track the market, earn 10% over time, and call it a day?
very few individual investors will do better than buying a ETF index fund.
Interesting. All right, hang with this, Richard. Go ahead, Richard. Go ahead. Go ahead.
Yeah, well, and the ones that are trading, the more they trade, the worse they do.
Yeah, that's true. Hang with us, Richard. We're going to go off for a short break. We'll be right back. All right, welcome back to Opening Bid Unfiltered here at the NASDAQ in Times Square. Having a fun chat. Richard Thaler. Richard, I can't think of a better person, well situated to weigh in on this AI bubble debate. From my vantage point, I get the excitement over the AI trade, the AI infrastructure build out around the world. I don't think we're at bubble levels. What say you?
I don't have a professional opinion about that. And I don't know how we would know. You know, let's go back to the late 90s. And there was what looked like a bubble. You know, if you added .com to the name, the stock price would go up. Now, and NASDAQ fell by 2/3, something like that, after 2000. So ex post, it was obviously, well, ex post, it looks like the people who said it was a bubble were right. Who knows? And now that's not to say there weren't winners. So if you were betting on Apple and Microsoft and Amazon, those bets turned out to be right. If you were betting on pets.com, you lost all your money. And so is there a bubble in AI? I don't know. There will be winners and losers. We don't know which those will be. And we don't know how big AI will be in terms of economic returns. I like to compare it to the iPhone. The iPhone is, for me, the biggest technological change in my lifetime. I have a computer in my pocket. I have access to all the world's data and information and GPS so I don't get lost. Right? That was life-changing. Will AI change my life more than that? I mean, AI is already driving my GPS, right?
And it's tracking your yardage on the golf course too, Richard.
It is. It says my drives are about 280.
That's pretty good, man.
Yeah, that's a blatant lie. Only adding 100. So our life has been changed by technology. What the change of adding AI will be, I don't know. I don't see how anyone knows. There's obviously huge potential, but I don't see how we know what the economics is. Let me give you an example. Back in the late 90s, I kept saying, I don't see how Amazon can ever make money.
Yeah.
Now, I think I was right. The idea of selling books and losing money on each one seemed like it wasn't a money market then, a profit opportunity then. It still doesn't, right? Who knew the cloud?
Yeah.
Right? So will one of these or one or more of these players figure out a way to make a lot of money on this? I don't know.
How do you, Richard, how do you know, how could one spot a bubble? Like, what are some of the characteristics?
Well, you know, you can start with some fundamentals, but when we're at these early stages where there's essentially no revenue, you know, back in the tech bubble, when they switched from PE to price to revenue, and for a lot of these companies, there's not even revenue. So it's impossible to to make a judgment now. What are the revenues going to be, and how competitive are the markets going to be? And if somebody gets a monopoly or significant market power, if there's an Apple or a Microsoft or an Intel, going back 20 years, then they're obviously going to make a lot of money. We don't know which one of those it'll be. And, if you think another ancient example, video stores, right? There was a boom. Every mom and pop started a video store. They got driven out of business by Blockbuster, which became a monopolist. Then came along Netflix. They tried to sell their business to Blockbuster. Blockbuster said no. And then Blockbuster went poof. Now, Netflix didn't capture all the market because then Amazon Prime, right? There's lots of competition for that. So even if you get a monopoly, you're not safe if somebody else comes along.
This has been an amazing year for the stock market, Richard. There's been every reason for this market to not be up double digits. Tariffs, policy uncertainty, slow growth overseas. What's the psychology that has set this market up to these levels? And the level of resiliency, I think, has surprised a lot of folks, and it has forced them to play catch up in many respects.
If I knew, I would tell you. I don't understand it. It seems like, of course, the market, we talk about the market as if it were a thing. It's a voting machine. And I think there are a lot of people, FOMOs. I don't know. I don't know how we can ignore tariffs and policy uncertainty. The only story I can tell is market participants think there's a bad dream and it's going to go away. Mm-hmm. So the kind of taco model that Trump is going to come to his senses and we're going to wake up and it's all going to be fine. There is not a single economist I know who thinks that the tariff policy is sensible. And, University of Chicago runs a poll I'm not saying just people I know. There's a poll of 50 well-known economists across the political spectrum. They all think this is bad. Mm-hmm. So how the U.S. stock market is ignoring that, I don't know. Yeah. Maybe they know something I don't know.
Lastly, Richard, before I let you go, we always love to get a hot take from our guest at the end. Nothing planned, just off the cuff here. Who is your favorite investor and why?
Well, you got to go with Buffett. Long-term track record, and a little
bit of a stock picker, Richard. A little bit of a stock picker.
Yeah, a little bit of a stock picker and a bit of a sweet talker. He's got a lot of widows to sell him businesses at good prices. If they want to come talk to me, I'm almost as old as him.
Fair enough. It was good to finally talk with you, Richard Thaler, author of the new book, co-author of the new book, The Winner's Curse, Behavioral Economics Anomalies, Then and Now. Good luck with the book. We look forward to staying in touch. Appreciate it.
Okay, great to talk to you.
All right. All right, that's it for the latest episode of Opening Bid Unfiltered. Like I always say, hit us with all that love on the social media platform and YouTube. I love all the feedback. It makes me better at doing these interviews. So keep them coming. Hit us with those ratings. I appreciate it all. We'll talk to you soon.